Hi, everyone. I hope this message finds you doing well. I'm David Silver, CEO of Instrumental Wealth. And over the last couple of days, we've been receiving some correspondence from clients around Silicon Valley Bank and the events that have taken place. And really, I thought it would be super helpful if we could send out this recording to everybody to hopefully give them some clarity around the situation and the events that have taken place. So I'm going to break this down into the old-fashioned who, what, when, where, how, why, and really sort of unpack this. And I think, you know, the facts are the facts. The sort of what happens next are still to be determined and a little bit murky here. But the first question is who? So Silicon Valley Bank, which is a top 20 bank in the United States, went into receivership on Friday around lunchtime. What does that really mean? Well, basically, if you unpack the financials of a bank, or really just, you know, conceptually how a banking business model works, is essentially you make deposits. You and I, as consumers, we all typically use the banking system. The bank is able to lend out or make loans at a certain ratio based on the amount of deposits that they have, okay? And so if you sort of break down the sort of, you know, fundamental business operations of a bank is, as a depositor, that's an asset to us, but for a bank, that's technically a liability, right? The assets of a bank are loans that they make or investments that they make in things like Silicon Valley Bank did in mortgage-backed securities. So as a depositor, I deposit money in a bank, and that bank may pay me some nominal amount of interest. And really the business model of a bank is to loan out money to other individuals at a higher interest rate than what they're paying their depositors. Okay, that's sort of the fundamental aspect of banking. From sort of just a business perspective, okay? And so what ended up happening, there's a lot of details to unpack. I don't want to put anyone to sleep here watching the video, but I think at a high level, just to kind of understand what took place, is that the depositors had a run, what they call a run on the bank, meaning there was some negative news that came out about Silicon Valley Bank, and the depositors were very concerned. And so everybody tried to transfer money out of the bank at the same time, hence what they call a run on the bank. Now, a bank, because they're making loans to people, or in Silicon Valley Bank situation, they invested money in what are called mortgage-backed securities, or MBS is an acronym that we use in the investment world. And essentially these were longer duration, about 10-year duration MBSs, which mean that they were mortgages that matured somewhere between now and 10 years out. The problem with those is that they're not totally liquid, and where they actually made a lot of the investment in MBSs was when interest rates were paying on those MBSs about 1.8%. Today, just to sort of give it some context, those same MBSs are around 5% because of the rate hikes. And so if they were to liquidate those securities to then free up cash to let the depositors withdraw money from the bank, they would have to take a 30 to 40% hit to those mortgage-backed securities in order to get liquid. Okay, and so what ended up happening is their duration didn't match their liability, and that's essentially what happened. Now, there's a lot more detail in this, and there's a lot of other areas of the bank that maybe were slightly concerning with some of the other aspects to their balance sheet. But for the sake of the conversation today, that's essentially what brought them down, okay? So that's kind of the who and the what happened, and really sort of the why this happened. Now, I will say that banking regulations since the global financial crisis have actually made it to where these type of events are less frequent. The Dodd-Frank bill had some mixed reviews, but I think really this was passed after the global financial crisis, in essence, to make sure that the plumbing of the financial system, the banking system, meaning if I put money in a bank, I hope it's there. In fact, I trust that it's there. It's like the plumbing of my house, right? I just hope that it works effectively. Otherwise, we're going to have a big mess on our hands. The Dodd-Frank bill, a lot of the rules and regulations that came out of that were to really shore up the banking system. This is sort of the one nuance, though, with the banking regulations that I would expect on a go-forward basis that our Congress men and women can get their act together and come up with a solution here where this can never happen again, because there's sort of one exception to this rule of marking to market, which marking to market just means basically every single day or every week or every quarter, depending on the rules and regulations around the security that's held by the bank, you have to basically adjust your balance sheet and mark those assets to market. And so what happened with Silicon Valley Bank, one of the root issues here is that there's this sort of loophole in the regulation that if you buy mortgage-backed securities, you don't have to mark those to market. And so the asset value of those MBSs were essentially coming down as interest rates went up, just like any other fixed income instrument or bond. They have a negative correlation to interest rates. However, because of the regulations, SVB did not have to mark to market the asset level being cut down to 40%. And so, or cut down by 40%, forgive me. And so what ended up happening was they had an artificially high asset base against their liabilities. And so they didn't do anything that was illegal. It's sort of a loophole here in the banking rules and regulations. And so I think at the end of the day, you know, what happens from here is really, really important, because at the end of the day, really the fabric of our financial system is just a viable banking system. I mean, if I can't trust that my deposits are safe in a bank, that there's a lot of things in question. And I think last night at about 6:45, the Treasury Secretary and the chairman of the Fed essentially came out with making sure that all depositors were going to be made whole and they could withdraw their money this morning if need be. And thank goodness they took action. You know, this is a pretty similar program to what we saw actually in the global financial crisis in 2008 with Troubled Asset Recovery Program, or commonly referred to as TARP, where essentially the Fed and the Treasury backstop the entire banking system. And I'm glad that they did that, because this could quite possibly have turned into a contagion. And I think just everything from, you know, good viable companies that, you know, had more than the FDIC limit in the bank are worried about how they were going to make payroll this week. I mean, this is how important this issue really is to the fabric of our financial system and our economy, for that matter. So I'm glad that the Fed did what they did, as well as the Treasury, to really backstop the banking system. I think, though, this really was a critical move, a must move. I actually support the action professionally and personally, because if there would have been a run on the banking system, this could have really turned into a contagion style event, and thank goodness it hasn't. Obviously, equity markets took a big hit the end of last week, and today they're down about 1 point as I'm doing this recording, but certainly could have been a lot worse. And I think we'll wait to see the discussion that's had by our leaders in DC and the banking regulators, because I think at the end of the day, Americans have to trust the banking system. And so they really need to get rid of some of these loopholes like this, in my opinion, and shore up the banking system. So there's a lot more to unpack here, and probably later on in the week or next week as the events sort of transpire. I think we're probably going to do sort of a fireside chat, if you will, around this, because I think there's a lot of discussion around this that clients want to know about, and I think the public deserves to have some clarity around this, and candidly, how this can never happen again. So I wanted to get this message out to everybody to really discuss the events that have taken place and where we're at today. I'm confident that the actions that have taken place on Sunday night give me the confidence in the banking system, but I think they need to do a little bit more here, and I think likely our leaders in DC will be having some deep discussion around this over the next couple of days to reevaluate some of these rules and regulations. So if you've got questions around this, hop on our website at instrumentalwealth.com, schedule some time with your advisor. We'd love to have a deeper conversation with you around this if it's of interest, and stay tuned for some more content that we'll be sending out to all of our clients here over the next several days and weeks. Thanks, everybody. Have a great start to your week.